Okay, I see that there are several of you here already. So I will give you the opportunity, if you go into the chat box, if you have any questions, you can ask them here. Or if there's something that you want me to for sure cover, it could be a homework question, it could be maybe a topic that maybe you're not clear about. Please ask it there, because what I'd like to do is when I start at 8 o'clock is to address those questions first, and then after that I will go to what I was planning to give you, which is the adjusting entries. All right, any questions from anyone? I have emailed you this file on adjusting entries. And I will be covering from some of that. All right, so a question from Joyce says that does the homework that we submit get graded? And the answer is yes. Once you've completed the homework, then it will give you a score on what it's able to auto grade, and then I will come through and grade the assignments for the parts that, like if it's a journal entry, that the computer cannot grade. However, at the same time, I will be reviewing what the computer graded, because the system is somewhat nitpicky. It reads the answers as text, not as a number. And when that happens, if you don't have it exactly like the answer says, that it's going to mark it wrong. You know, so if you put in 100.00 and it's just looking for 100 without the decimal point, it's going to mark it wrong. But I go through those and grade them manually afterwards so that you will get your points. Okay, Joy, I'm going to have to take a look at that after we're done with this session to see. So I'm just going to put a note to myself here to check. I'm going to check on that, because it looks a little bit odd. It may be that it's not going to actually give you your score until after the deadline has passed, but I'm not 100% sure of that. Okay. All right. So those of you that are on here, we still got 7 minutes till we start. So if there is a particular question on the homework, please feel free to ask it right now. All right. Okay. Okay, so I tell you what, since I'm recording this, I am going to go ahead and get started. And please, you can always unmute yourself if you want to ask a question, or you can ask your question in the group chat as well. I will be monitoring the both of them as we go along. And let's see here. Alrighty. So I'm already making the assumption that you understand what we covered in the first week, which is preparing journal entries. And now in this week, we're talking about completing the process of accounting for a given period. Now, most transactions, there's going to be a document or a receipt that gives us the information that we need in order to prepare a journal entry. For example, when the electricity bill comes, they receive the electricity bill, they know they can then debit utilities expense and then credit an account payable since it's not yet been paid. And then when it's due and paid, you would debit accounts payable and then credit the cash. But that transaction is defined by then this utility bill. All right, wages and salaries, similarly, there is some recorded document. But what happens is when we come to the end of the period, there are transactions or not transactions that are recorded because they're not yet recorded, and there oftentimes isn't some kind of a documentation that would let the accountant know that it's time to record it. And these are what we call the adjusting entries. And adjusting entries are entries that we're going to make at the end of a period. It could be monthly, quarterly, or certainly has to be at least annually. And the adjusting entries we're going to prepare in order to make sure that all of the revenues earned in the period that's just ending are recorded in that period. And all of the expenses that were incurred in the period just ending are recorded in that period. And so sometimes this does not, you have to kind of make it a point to prepare those adjusting entries. So I'll give you an example here. So the revenues should be offset against the expenses that were incurred to generate that revenue. So our example here is that the bookstore sells a textbook in January for $139. The textbook costs the bookstore $65. So even if they purchased the book in December or November prior to the period when it was sold, they are not going to record the expense, which is the cost of goods sold, until the period when the textbook is actually sold. So Adjusting entries, again, as I said before, we want to make sure that the expenses are in the period when they were incurred and that the revenues are recorded in the period when that revenue was earned. All right, so I'm kind of skimming over some of this because you could read it on your own, but let's talk about the types of adjusting entries. There are adjusting entries that are what we call deferrals. And a deferral means that either the cash was paid prior to the expense being incurred. Common example is insurance. All right, if a company buys a 2-year insurance policy and they pay for it up front, then that insurance covers 2 years, but we cannot record the expense all in the year when the insurance policy was acquired and paid for. All right, so that is the cash was paid, but the expenses are going to be incurred in future. That's the first type of deferral. The second type of deferral is an unearned revenue, where the customer has paid cash before the revenue is either earned or the good that was purchased was delivered. All right, so those are the two kinds. I also should mention here that there is depreciation. And depreciation has a special meaning in accounting. Most of us think about if you purchase a car and then there is the depreciation, the car decreases in value. But from an accounting perspective, depreciation just means that we're taking a long-lived asset and allocating the cost to the years or the months that we use that asset. So it is possible, like with a car, that the depreciation is an indicator of a decrease in value. But in other cases, for example, if a building is purchased, the building may actually increase in terms of its fair market value, but we still depreciate it because the cost of that building made it possible to generate revenues. The cost of the factory makes it possible to be able to generate revenues. And so therefore, we're going to depreciate or allocate a part of the cost to each period when we use the asset. All right, that's generally speaking. There are some more specifics, and I can get into those, dear me, I think in 3 or 4 weeks when we actually talk about property, plant, and equipment. All right, the second type, I already mentioned this, unearned revenues. And then the second type that we have here are accruals. And accruals mean that the revenue is earned or the expense is incurred before the cash is paid. So the example I gave you before about the electricity bill, we use electricity in December. The bill comes in January, it's paid in February. And so therefore, we need to be sure that we record in December an expense that relates to that utility, the electricity that was used during the month. And then there are accrued revenues, and accrued revenues means that the revenue has been earned or the goods have been delivered, but the cash has not yet been received. And an example of this that I give you in those notes there is interest. So if the company lends money to another party or another organization, and so let's say on the 15th of September, they make a loan that's due on the 15th of September of the next year, and the interest will be paid in the next year. When we get to December 31, we need to record some interest revenue or interest income for the interest that was earned between the 15th of September and the end of the year. But we don't receive it until we receive a whole year's worth of interest on September 15 of the following year. All right, now here are a couple of other things that we want to take note with regards to adjusting entries. All right, when we're preparing adjusting entries, please note every adjusting entry is going to have either a revenue account or an expense account. Revenue account could be interest income or interest revenue. It could be rent revenues, or it could be sales revenues. All right, it's either going to be a revenue or an expense. And expenses would be like utilities, wages, income tax expense. So there's going to be a revenue or an expense in every entry, every adjusting entry. And then the second part is that there's also going to be an asset or a liability account. Now, an asset account, for example, may be prepaid insurance or prepaid rent. A liability account, wages payable, accounts payable, interest payable. And also note that never are we going to be using the cash account when preparing a journal entry. All right, I'm going to take a quick little pause right now and see if anyone has any questions. So if you want to unmute yourself and ask a question, or if you want to post, okay, or if you want to post it into the group chat, I'll give you a chance to kind of do that right now. And so I'm going to pause for maybe about a half a minute or so. Okay, well, now I'm going to talk about actually preparation of the journal entries. All right, so the first one that we're going to look at here is a prepaid expense. Prepaid expense means that the cash has been paid, but the expense not incurred. All right, so here we go. John Deere Manufacturing Company purchased on the 1st of August a 2-year fire insurance policy for $2,400. This was the premium. And we will assume that John Deere's fiscal year ends on the 31st of December. So what would be the journal entry that we would record on the 1st of August when the fire insurance policy was acquired? So we have here the 1st of August, and we're going to record prepaid insurance. And that was $2,400. Then, all right, it says here that they paid cash. So what we need to do then is to credit cash, $2,400. Now, please note, this is not the adjusting entry. This is just the entry that we have to record the acquisition of the insurance on the 1st of August. All right, now I'm going to move this into the T accounts. So, one second here. All right, so the first thing that we have here was that the prepaid insurance was debited for $2,400 and the cash was credited for $2,400. All right, that is this first transaction. Now, the next thing that we need to do, and I'm going through this step by step, so hopefully it will explain the process. All right, so the insurance policy was $2,400, and it lasts for 2 years or 24 months. And so therefore, the premium is $100 per month. Just one second. Sorry about that. All right. So now, okay, how many months of insurance have been used up or expired or consumed during the 2015 year? Well, this was purchased in August. So it's all of August, September, October, November, and December. So this is 5 months. That means then that 5 months of the 24 months needs to be expensed. And expense means that we're going to transfer it out of prepaid insurance and into insurance expense. All right, so it's $100 a month times 5 months, and this is equal to $500 is the amount that we need to expense. So therefore, the adjusting entry on the 31st of December would be a debit to the insurance expense, $500, and a credit to prepaid insurance, $500. All right, so in effect, what we're doing here is remember prepaid insurance, it's an asset. Assets increase on the debit side, and when we credit an asset, we're decreasing that asset. So now let us then post to the T accounts so we can determine what is the balance in the prepaid insurance and the insurance expense accounts after the adjusting entry. All right, so so here we have a debit to insurance expense, and the debit is $500, and we have a credit to the prepaid insurance, and this is $500. So now, what is the balance in these two accounts? All right, so when we have a T account, really what we do is add up what's on the debit side, add up what's on the credit side, and then the difference will go on the side that is larger. So 2,400, only one debit, one credit of 500. So then we would have a $1,900 balance in the prepaid insurance. This is the asset. And a $500 balance in the insurance expense account. All right, so with the adjusting entry, what we've done is transferred out of prepaid insurance and into the insurance expense account the amount. I got a notification that the meeting can go on longer than 40 minutes, so hopefully that's good. So what I was saying here, we transferred out of prepaid insurance into insurance expense the amount that has been used up or consumed. Okay, again, if you have any questions, please feel free to speak up and ask. Now, let's just take a look here and see if we did not record this adjusting entry. And let me just label the adjusting entry in color or a different color. So I'll make this some kind of a red, I guess. And oops, sorry. That's not what I wanted to do. Okay, so if we don't record this entry, what's going to be the impact on the financial statements? All right, so in this case here, prepaid insurance is an asset, An insurance expense is an expense account. So the impacts are going to be on assets and on expenses. All right, so there is, in this case here, none of these are revenue accounts, so there is no effect on revenues. If we don't record this 500, then the insurance expense would be 0 when it should be 500. So the expense then is understated. All right, so let me just repeat that. If we do not record this 500 of insurance expense, the balance is going to be 0. So when we record or we do our report, insurance expense is 0, but that's not correct. It should have been $500. All right, so we understate the amount of the expenses. Now, what's the impact on net income? And this is going to be a formulaic impact. All right, this is to say that if revenues are the same, but expenses are under or less, then that means that net income will be overstated. All right, so let's just make an assumption. Let's say that revenues were $2,000. All right, so I'm going to just say here as an example, let's pretend that it was 2,000. All right, the expenses, if they were reported as 0, this means that the net income would be, making it very simple now, 2,000. But really, it should be how much should it be? Well, the expenses should be 500. So 2,000 minus 500 would give us 1,500. And so therefore, 1,500 is really less than 2,000. And so if this adjusting entry was not recorded, then the net income would be overstated. Now, let's continue on. These are what's in the income statement. Now we look at what the balance sheet has. Now, prepaid insurance. If the adjusting entry was not recorded, prepaid insurance would be $2,400, but it should only be $1,900. So therefore, the assets are overstated. All right, so again, if we do not record this adjusting entry for the insurance expense, then our assets will be overstated. All right. Now, when it comes to liabilities, remember, this is an asset account. This is an expense account. So therefore, there is no effect on liabilities. But there is an effect on equity because as profits or net income, if net income goes up, then equity will go up as well, in particular the retained earnings. So what's going to happen is whatever happens to net income is what's going to happen to the equity, because net income is a part of the equity. And when we get to closing entries, or I think we are actually covering them right now, then you remember using the income summary and debiting the income summary account and crediting retained earnings for whatever is the amount of the profit, if there was a profit. And if there was a loss, it would be the opposite. Debit the retained earnings and credit the income summary. So this would be overstated. Okay. I want to pause for a hot second and see, is Are there any questions or on this or anything else? All right, now I'm going to continue on with the second type of adjusting entry. And the second kind of adjusting entry, again, has to do with unearned revenue. And unearned revenue means that they've received the cash, but they have not yet provided to the customer the good or the service. All right, so here is our example. All right, the fulfillment company sells annual subscriptions to its monthly magazine, Joyful Horizons. Each subscription costs $30 a year. And on the 1st of October, they sold 15,000 subscriptions, which were paid in advance in cash. All right, so how much did they receive? And how much they received is going to be $30 a subscription times 15,000 or $450,000 that they received. But clearly, this is an annual subscription, so this $450,000 is going to be earned month by month as they send the issues to the customers. All right, so on the 1st of October, the journal entry that we would prepare, or that fulfillment company would prepare. So this is on the 1st of October. This is recording the sale of the subscriptions. They would have received cash, $450,000, and then they would credit unearned subscription revenue, and that would be $450,000. All right, let me just pause here and reiterate some of the things that I've said regarding formatting of journal entries. First of all, number one, the date. Please note that we only put it to the left of the first debit in any journal entry. Don't need to put it in by this credit or any other debits and credits. And then also notice here that I don't use the dollar sign because we work under the monetary unit assumption, which means that we are recording our transactions in dollar amounts. Okay, so that is then the journal entry when the subscriptions were sold and the cash was received. So how much revenue was earned with each monthly issue? So how much did they earn each month? Well, it's $450,000 divided by 12. And 450 divided by 12 is 37,500. All right, I have a question here, and I think all of you must have seen this here. Is 1 October correct, or would 10/1 be okay? It doesn't make any difference. I've lived abroad for a long enough time and where we use the dates like this, so I've continued using them even after I returned to the States. And it kind of makes sense, you know, it's day, month, year. Or I think in the military they do year, month, date. But if you say October 1 or 1 October, either is acceptable. All right, now, so in 2014, how much subscription revenue was earned? All right, now I'm going to make the assumption that they were able to send the October issue out to their customers. And so we would have October, November, and December, 3 months. So 37,500 times October, November, December, 3 months. All right, and that would be equal to $112,500. All right, so that means that by December 31, we need to transfer out of unearned subscription revenue $112,500 into earned subscription revenue, or as we call it, just the subscription revenue account. All right, now the next question is saying then at December 31, how much of the subscription revenue was still unearned? Well, recall that they received $450,000 and $112,500 was earned. So that means that in the unearned subscription revenue account, after we've recorded the adjusting entry for the earned subscription revenue, there should be $337,500 in the account. So now let's go ahead and prepare the adjusting entry that we need for at December 31. All right, so in this case here, recall that we had credited unearned subscription revenue when they sold the subscriptions. And unearned subscription revenue is a liability account. All right, the fulfillment company needs to do one of two things: supply those monthly issues of the magazine to their customers or give them the money back. So that's here a liability. But since they've already supplied 3 months worth of subscriptions or issues, 3 issues, then that is earned. It's no longer unearned. So we're going to debit unearned subscription revenue for let me see, $112,500, and we're going to credit then subscription revenue, $112,500. Okay, now I'm going to give you guys a chance to do a little bit of practice. And what I want you to do is, if you go to the chat, and instead of saying to everyone, just send it to me. And actually, I'm going to change it so that you're just going to be able to send it to me. And for so revenues, expenses, and net income, just those 3. I want you to report whether they are understated. So let me give you the options here. They are understated, overstated, or no effect. All right, so we have here, is it understated, overstated, or no effect? All right, so take a moment and list each one of these. Revenues, overstated, understated, no effect. Expenses were overstated, understated, no effect. Net income, overstated, understated, no effect. And please note here, remember, we're answering the question, what is the effect if the adjusting entry is not recorded? Okay. All right, I'm getting some answers, and there are, let's see, 9 of you here, so I'm going to give a couple of more moments for everyone to have a chance. Okay, so let's take a look here. The first one that we have is revenues. Okay, if we did not prepare the adjusting entry, then $112,000 of earned revenue would not have been recorded. And so therefore the revenues would be understated. Now, these accounts, remember the two accounts that we have here. This is a liability account, unearned subscription revenue, and subscription revenue is a revenue account. And so there is no effect on expenses. And then finally, net income. Well, if we reduce the amount of revenues and the expenses are still the same, then net income will also be understated. All right, so just recalling that we're assuming here that this revenue from December 31 is not recorded. So that means that there is understatement of revenues. But also, when it comes to assets, these are not asset accounts. It's a liability and an expense account, so there's no effect on the assets. The liabilities, please note, the liability would be $450,000 because that's the amount that was originally credited to the unearned subscription revenue account. But it should be $337,500. So therefore, the liabilities are overstated in this case here. So there's no impact on assets because there are no asset accounts. But there is an impact on the liabilities because the liabilities are at $450,000 when they only should be at $337,500. And then again, when it comes to the net income, it was understated, and then that's going to then understate the equity. All righty. All right, now the next category of adjusting entries is the accrued revenues, sometimes called accrued assets. All right, so this is revenues that are earned but not yet received in cash. All right, so Max Good Company made a loan of $100,000 to its president, Mr. Schmidt, on the 28th of February, 2014. The loan was due to be paid with interest on the 28th of February, 2015. So what happens is with this loan, Max Good has earned interest from for March, April, May, June, July, August, September, October, November, December of 2014. But they won't receive it until February of 2015 when the president repays the $100,000 with interest. So what's the journal entry going to look like? All right, so here we go. Let's see here, 31 December, and this is the adjusting entry, pardon me. The adjusting entry will be a debit to interest receivable. And it's interest receivable because they've earned it, but they've not yet received it. And interest receivable is an asset. All receivables are assets. And they tell us that the interest earned during 2014 was $8,000. And then the credit that's going to be recorded will be a credit to interest income. Sometimes they say interest revenue. Either is okay, and this would be $8,000. So now the question is, all right, what is the effect on the following if this adjusting entry is not recorded. And just remember that we're talking about, it's either going to be understated, overstated, or no effect. Okay, and so I'm going to give you two. Let's say revenues and assets. And I'll give you one more, equity. All right, so yeah, so what I want you to do again is tell me what's the effect on revenues, assets, and equity if the adjusting entry is not recorded. Okay. All right, so someone is asking a question about this interest receivable. And technically, the account name is interest receivable. We don't really use interest receivables, but rather just interest receivable. However, please note that if you have it marked incorrectly, when I do the hand grading, I will give you those points back. But if I don't, please let me know so that I can make that correction, okay? All righty. I'll give another few seconds for anyone else who would like to attempt, and then we'll go over it together. Okay, so here we go. This is the entry here, a debit to interest receivable and a credit to interest income. All right, so interest income is a revenue account. If we don't record this, then revenues are going to be understated. Now, this is a revenue and asset account, so there is no impact on expenses, so there's no effect. When it comes to net income, if revenues are lower than what they should be, expenses are the same, then the net income will be understated. Now, when it comes to assets, we should have a receivable of $8,000, but we don't. So assets are understated. Liabilities. Well, this is a revenue account. This is an asset account. So there's no effect on the liabilities. And then finally, if we understate net income, then we will understate the equity. Okay. The next one that I'm going to do will be accrued expenses. All right. And in this case here, the Irwin Company. Now, let me explain what accrued Okay, thank you. I will try to slow down. I know I tend to speak quickly, so I'll slow down. All right. So now we're talking about accrued expenses. And an accrued expense is an expense that's incurred but not yet been paid. So if you remember from the beginning of this session, we talked about the utility bill. So electricity, it's used up, so to speak, in December. But the bill is not received until January and then not paid until February. So therefore, at December 31, or at least dated December 31, we need to record a utility expense and a liability for the utilities that were used up during December. All right, so accrued expenses. That means that the expense has been incurred or used up, but it has not yet been paid. All right, here's an example. The Irwin Company pays salaries on a bi-weekly basis. Salaries are paid on every other Friday, and the salaries are for that week and the previous week. All right, the last payday for the year is the 24th of December, and the first payday of the new year is the 7th of January. And bi-weekly salaries amount to $8,500. All right, so if the last payday was on the 24th of December, so that would be a Friday. A week after that, 7 days later, would be the 31st of December. So, assuming that everyone works Monday to Friday, how many days of unpaid salary would there be? And there would be 5 days of unpaid salary. That's that Monday, Tuesday, Wednesday, Thursday, Friday that ends on the 31st of December. So, what is the salaries earned per day? Well, it would be $8,500 divided by 10 days because it's bi-weekly. So 1 week has 5 working days. The second week has 5 working days. So we divide it by 10 days. And this would be $850 is the salaries earned per day. All right, so how much is unpaid? And in this case here, it's $850 per day times 5 days. And that would be equal to $850 times 5. Oh yeah, $4,250. And some of you might say, well, you know, it's 1 week, half of 8,500. And that's true. However, if the year ended on a Wednesday, then it would be Monday, Tuesday, Wednesday, maybe 3 days. So that's why I've done it on a per day basis. So now what is the adjusting entry? So on the 31st of December, we need to record an expense, salaries expense, of $4,250. That's for those 5 days that will not be paid until next week, which is in January. So we're going to debit salaries expense for $4,250, and we will credit salaries payable for $4,250. So please note here, salaries expense is an expense account. Salaries payable is a liability account. So, okay, I'm going to give you 3 of them. Revenues, assets, and liabilities. If the adjusting entry is not recorded, what is going to be the effect on revenues, assets, and liabilities? So if you would send your answer in through the chat, I'll give you a few moments to work on that. Okay, I've gotten a few answers. Let's just take a look at this entry again. And we've got 2 accounts, expense and a liability. So if we don't record this adjusting entry, salaries, well, there's no effect on the revenues because this is an expense account, that's a liability, so there will be no effect. When it comes to expenses, if we don't record this $4,250, it will be, the expenses will be understated. They will be $4,250 less than what they should be. All right, so if expenses are lower than what they should be, net income will be more than what it should be, or it will be overstated. And again, a liability account, salaries payable, an expense account, salaries expense. These are not asset accounts, so there is no effect on assets. But there is an effect on the liabilities because the liabilities should be $4,250 more than they are. They would be increased by $4,250, but we didn't make the journal entry, so therefore the liabilities are understated. And then finally, equity. Again, when we overstate net income, it's going to overstate equity. All righty, and now the last adjusting entry, which is depreciation. All right, excuse me, I need to take a sip of water. All right, so what is depreciation? And remember, for those of you that were here when I started this session, from an accounting point of view, depreciation just means that we're taking the cost of the asset and expensing it bit by bit over the period or the years when we use that asset. All right, and we depreciate because of the matching principle. The matching principle says that we need to match the expenses with the revenue that they generated. So if a company has a piece of machinery and the machinery has an expected life of 10 years, so we need to then allocate the cost of that machine to 10 years so we can match some expense for using that machine to the revenue that's earned in each of those 10 years, or the revenue that's generated. All right, so from an accounting perspective, depreciation has nothing to do with the decline in the fair or market value of an asset. Okay. And also, please take a note that depreciation, we are going to estimate it. Why do we estimate it? Because when we purchase an asset, we estimate the useful life is going to be X number of years. A computer, maybe 3 years. Furniture and fixtures, maybe 7 to 10 years. Machinery, well, depends on what it is. Could be 10, 15, 5 years. All right, so we're going to be estimating, and we're estimating two things. We're going to estimate the life of the asset, and we're also going to estimate kind of what we expect to receive when we sell the asset after we're finished using it. Of course, that could be zero as well if we say, okay, when we're done, we just take it to the dump. So here's our example. Procter Company purchased a piece of equipment on the 1st of January, 2015. The equipment cost $22,000. So this is the one thing that we know. We know the cost. And then we have here the expected or estimated useful life is 5 years. And at the end of the useful life, the equipment is expected to have a salvage or scrap value of $2,000. So we use it for 5 years, and we estimate that at the end of the 5th year, we're going to be able to sell the asset for $2,000. So how do we compute the depreciation expense? And the computation is we're going to take the cost of the asset. Let me see if I can make this just a little bit bigger. All right, so we're going to take the cost of the asset and subtract away the salvage value. And then all of that we divide by the useful life. And in this case here, the useful life is in years. Oh, sorry. I'm sorry about this. Oh dear. I get I don't know if you guys are getting them too, but there's no caller ID and my phone doesn't even give me the option to hang up. Anyway, so, and this is the useful life in years. In this case here, because we know that the useful life is 5 years. So how much or what would be the amount of the depreciation expense per year? And that would be cost of $22,000 minus the estimated salvage value of $2,000. That gives us $20,000 divided by 5. So $20,000 divided by 5 is going to be equal to $4,000 a year. So, with that information, now we're ready to prepare the journal entry or the adjusting. Let me add this here. Journal entry to record the depreciation expense. And we're going to record the, depreciation expense, and for the amount that we calculated, $4,000. In addition to that, or the credit part of the journal entry, we're going to use an account that's called accumulated depreciation. And let me explain to you a little bit about this account. Accumulated depreciation is what we call a contra asset account. A contra asset means that it belongs with the assets, but it goes against or is contrary to a asset. In this case, the asset is equipment. And so this here is a contra asset, and it's $4,000 to accumulated depreciation. So, and I'm going to talk about this a little bit more later on in terms of the accumulated depreciation account. But let's just go over together here. What's the effect on the following if this entry is not recorded? All right, revenues. Now note here, this is an expense account. This here is a contra asset. So there is no effect on the revenues because a revenue account has not been used in this adjusting entry. The expenses, if we don't record this depreciation expense of $4,000, then the expenses will be understated. And if expenses are understated, net income will be overstated. All right, let me give you another example. Let's see here. I am going to, let's see, insert a column to the left. All right. Okay. So let's say, for an example, that we have a company and their revenues are $5,000 a year, and the only expense that they have is depreciation. So if they recorded no depreciation expense, it would be zero expense. And that means that the net income would be $5,000. Now, let's see here. I'm going to try to, let's say, split these cells into, no, 2 columns. Okay. All right. And in this column here, just to help with the visualization, alrighty, I'm going to say there's no effect on the revenues. The revenues would be $5,000, but the expenses should be $4,000. All right, so they should be $4,000, meaning that then the net income should be only $1,000. So if this journal entry is not recorded, there's no effect on revenues. The expenses, though, are zero when they should be $4,000, and the net income is $5,000 when it should only be $1,000. Now, here comes the tricky part. What happens to assets if we don't record this adjusting entry? And please note here that accumulated depreciation is going to go against, contra to, equipment. So the equipment then would be at 22,000, which is the cost. Remember, we said the cost here was 22,000.
It's 21 hours.
But the cost should only, on the books, it should be 22,000 minus 4,000. So therefore, in this case here, the assets will be overstated. There is no impact on liabilities. And when it comes to equity, the equity will be overstated because the net income is overstated. Okay. All right, so let me talk a little bit more about contra assets. All right, so contra assets, such as accumulated depreciation, and we will learn about others throughout this course. Contra asset has a normal credit balance. So this says that the contra asset account increases on the credit side, but this contra asset account, accumulated depreciation, shows up on the asset side of the balance sheet. How does it show up? Well, here's an example. All right, this equipment that Proctor had, it costs, so let me just label here, this is then the cost, was $22,000. The accumulated depreciation, we're going to subtract away, and recall that the accumulated depreciation was $4,000. So we're going to subtract away then 4,000, and that will leave us with, a book value of $18,000. So this is the amount that would show up in the balance sheet as net equipment. And I know some of you have already submitted your SEC 10K discussion for this week. And the question was, or one part of it was to list the largest assets. And so for some of you, you may have seen net equipment or net property, plant, and equipment. And net means the cost after the accumulated depreciation. All right, so once we've finished then these adjusting entries and we've posted them, then we prepare what we call an adjusted trial balance. And the adjusted trial balance, especially in a manual system, will let us know that the debits equal the credits. If the debits don't equal the credits, then there is a mistake somewhere and needs to be corrected. Okay, I have finished everything that I had planned to go over this evening. Do any of you have any questions either regarding something I've done this evening with adjusting entries, or maybe a question about the homework or some other concept? So I'm going to leave the chat open right now so that you can ask your questions. What I plan to do after the session is over with, it takes a little while for Zoom to process the video. And they are processing it to my computer, so I'm hoping that it will somehow work out that I can give you the link to be able to see the video if you so desire, or you want to review something, or I was talking too fast at some point. But right now I am making it open for questions. Um, I shouldn't say next week, but later this week, because I know the homework is due tonight for week 2. I've got a little bit of a problem with trying to do a video next week because I'm going to be traveling on Sunday. What I will do is I will figure out a time when I can do it. I will let you know. If you can make it, fine. If you cannot make it, the plan will be to make the video then available to you. Again, if there is any particular topic that you want me to cover from week 3, please let me know, because this review session likely is going to be on Friday, maybe around 7. I'm going to be traveling back on Friday, but I think that I should be able to leave early enough that I get back home in time for 7 o'clock. Okay. All right. Well, if there are no further questions or comments, then I'm going to say good night to everyone. Please let me know if this session was helpful. And if you have any agreements, if you have any ideas to make it better, please let me know. Okay. All right. Thank you so much, and good night.